Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about CK Infrastructure Holdings Limited annual report. CK Infrastructure Holdings Limited offers a diverse range of businesses and services that cater to various infrastructure needs. At the core of its operations are energy infrastructure investments, which include power generation and transmission facilities. The company also invests in transportation infrastructure, such as roads, bridges, and tunnels. In addition to these key areas, CK Infrastructure Holdings Limited is involved in water infrastructure development, including desalination plants and water treatment facilities. Waste management is another significant aspect of the company's operations, with services that include waste collection, disposal, and recycling. The company also engages in waste-to-energy projects, which convert non-recyclable waste into electricity. Furthermore, CK Infrastructure Holdings Limited has a presence in household infrastructure, providing essential services such as gas supply and distribution. The company is also involved in the production and laying of asphalt, as well as the manufacture, distribution, and sale of cement. Its property investment arm focuses on developing and managing commercial and residential properties. Lastly, the company offers project management services to support its various business activities. Securities investment is another area where CK Infrastructure Holdings Limited operates, providing financial support for its infrastructure projects. Overall, the company's comprehensive range of businesses and services makes it a significant player in the global infrastructure sector. CK Infrastructure Holdings Limited maintains a market capitalization of $165 billion, broadly in line with the industry peer group. CK Infrastructure Holdings Limited trades at a higher price-to-earnings ratio of 19 times and a higher price-to-book ratio of 1.29 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 17% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 3.99%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline are multifaceted and varied across different sectors. On the growth side, organic expansion from existing portfolios, strategic acquisitions, and investments in new markets or adjacent industries have contributed significantly to revenue increases. Additionally, higher returns under new regulatory periods, guaranteed returns from national off-takers, and contributions from renewable energy sources have also boosted revenues. In some cases, specific projects such as network maintenance and renewal, underground power cables installation, and support for local flood resilience have generated additional income. Furthermore, the disposal of certain assets, such as UK Power Networks Holdings Limited, has resulted in one-time revenue gains. On the decline side, there are fewer instances, but notable ones include a decline in airport parking volumes due to trade tensions and lower sales of infrastructure materials and waste management services to joint ventures. The net income of a company has seen a decline due to various factors. Competition risks have played a significant role in this decrease, as well as interest rate fluctuations and volatility in financial markets. Additionally, cybersecurity risks have also contributed to the decline in net income. Furthermore, capital expenditure exceeding budgeted amounts, currency fluctuations, and labor market changes have also had an impact. The profit margins of the company have also seen a reduction. This can be attributed to increased competition and pricing pressure, which has led to reduced competitiveness. Regulatory reforms impacting non-regulated businesses have also played a role in this decline. Moreover, supply interruptions and network damage affecting utilities' investments have further contributed to the decrease in profit margins. The increasing operating and compliance costs due to evolving AA-specific regulations have also had an impact on the company's profit margins. The company has demonstrated a significant improvement in its ability to generate cash from its core operations. The net cash from operating activities for 2025 stands at HK $6,163 million, marking a substantial increase of HK $1,015 million compared to the previous year's figure of HK $5,148 million. This upward trend indicates that the company is successfully managing its day-to-day activities and generating sufficient cash to fund its operations, investments, and other financial obligations. As a result, it can be confidently stated that the company is indeed generating positive operating cash flow. The company's debt level and interest expenses have undergone significant changes over the past year. Initially, on page 55, it is reported that the total debt decreased by 1.1% from HK $25,767 million in 2024 to HK $24,667 million in 2025. However, this trend is contradicted by another report on page 77, which states that the total debts increased by HK $1,594 million, 8.3% increase, from $19,241 million to HK $20,835 million. A closer look at the breakdown of debt reveals that unsecured bank loans have seen a substantial increase, rising from HK $13,973 million at 1st January 2024 to HK $13,343 million at 1st January 2025. This significant jump in unsecured bank loans has contributed to the overall increase in total debts. In terms of interest expenses, there is a mixed picture. On page 55, it is reported that total interest expenses decreased by 8% from HK $181 million, 2024, to HK $111 million, 2025. However, on page 70, it is mentioned that interest expense decreased by plus 42 HK million, which seems to be a minor decrease. On the other hand, finance costs decreased by HK $50 million, 5.8% decrease, from HK $165 million to HK $115 million, as reported on page 77. Overall, while there are some discrepancies in the reports, it appears that the company's debt level has increased significantly due to a substantial rise in unsecured bank loans. The interest expenses have also seen some fluctuations, but overall, they seem to be decreasing slightly. The performance of various segments and regions in the market has been mixed. On a positive note, the energy segment and transportation segment have shown strong results. Similarly, Hong Kong and mainland China have performed well, driven by infrastructure investments and regulated businesses in power and infrastructure sectors. In contrast, some areas have struggled to keep pace. The water and waste management segments have underperformed, while New Zealand and Australia have also seen disappointing results. Non-regulated businesses, such as those involved in waste management and cement production, have also faced challenges. Continental Europe has been another region that has lagged behind, with its performance impacted by various factors. Management is optimistic about the company's outlook, citing its strategic focus on delivering regulatory outputs at the lowest cost possible. The company is investing in various sectors to drive growth, including infrastructure, consumer coverage, and generation capacity. Management also highlighted the importance of geographic diversification, with a strong presence in multiple regions. The company's risk management strategy is centered around mitigating market fluctuations, regulatory changes, supply interruptions, and cybersecurity threats. To address these risks, management is investing in cybersecurity measures and accelerating the development of artificial intelligence technology to enhance operational efficiency. Management emphasized the need for diversification across business segments and ownership structures, with CKI's ownership ranging from 25% to 100% across different subsidiaries. The company's significant customer base, including over 2 million customers in Canada, is also seen as a key strength. Overall, management's strategy is focused on driving growth through strategic investments, geographic diversification, and the development of new technologies such as AI. While acknowledging potential risks, management remains confident about the company's prospects for future success. The acquisitions and divestitures of the company have been significant over the past year. On the acquisition side, the company has made several notable purchases. In November 2025, Australian Gas Infrastructure Group acquired APA entities, while ISTA added SGW Metering to its portfolio in September 2025. Reliance Home Comfort also acquired 2 home service businesses in the United States during this time. In addition to these individual acquisitions, the company has made several larger purchases. Power Assets Canada and oil and gas midstream assets were acquired, as well as cement production facilities and concrete and aggregate production plants. The company has also invested in toll roads and bridges in Australia and distributed energy and clean energy projects. Furthermore, SA Power Networks was acquired prior to Basil Scarcella's appointment as Chief Executive Officer, and wind farms were acquired by the group. On the divestiture side, the company has sold several assets. In January 2026, UK Rails was divested, and in February 2026, a divestment agreement was signed. The sale of UK Power Networks to Engie SA is also notable, representing a flagship transaction for the CK Group. The company's financial history reveals a consistent trend of dividend payments. According to various sections of the report, it is clear that the company has indeed paid dividends at different points in time. This indicates a commitment to returning value to its shareholders through regular dividend distributions. However, there is no mention or indication of share buybacks in any part of the report. The focus remains on the payment of dividends as a means of rewarding investors and demonstrating financial stability. Concerns about inventory buildup and supply chain disruption are evident in various aspects of the industry. The data on inventory levels shows a significant increase in 2024 compared to 2023, with an additional $1,835 million at year-end. Furthermore, total inventory has increased by plus 5 million units from 113 million in 2024 to 118 million in 2025. The supply chain is also vulnerable to disruptions due to various external factors. Extreme weather and climate events pose a risk to distribution and transmission networks, while geopolitical tensions have disrupted the supply of raw materials, transportation, and port operations. Additionally, concerns about disruption to supply chains due to climate change, global pandemics, trade intensity, labor availability, and exchange rates in the UK due to Brexit are also present. These factors indicate that there are indeed concerns about inventory buildup and supply chain disruption, which could have significant implications for the industry's operations and profitability. That concludes the financial summary for CK Infrastructure Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.